Hi guys, welcome back to the channel. My name is Dave, and today I'm seeking alpha. I'm looking for an ETF that's beat the S&P 500 for the last several years. I'm talking about the last year, which was a rough one, the last 3 years, the last 5 years, the last 10 years, and yes, even the last 20 years. Something that's had that much consistency over a 20-year period. And guess what? I found something. If that is what you're looking for, please stick around. Whoop. So if you ever find a product that has beat the S&P 500 consistently over a 20-year period that included recessions, bull markets, bear markets, a financial crisis, a pandemic, etc., it's worth talking about. And this ETF has done just that. So today I want to dive in and do a quick review of this and talk about it and see, okay, well, it's had a great 20-year period. What does it look like going forward?
You ask for miracles, dear. I give you the FBI.
That's right, diehard fans. You want a miracle? I give you the XLV, the Spider Select Sector Healthcare ETF. Now, what you're looking at here is a chart going all the way back to 2000. The blue line, or orange line, represents SPY, or the SP 500. Same thing. The purple line there is XLV. And you can see going all the way back to 2000 to 2023, where we sit currently. SPY has returned about 180%, XLV 313%. Outstanding over a long period of time, greatly outperforming the market. And it does pay a dividend very similar to the S&P 500. So what you're looking at here is the price return. But if we look at total return as well, for those that like to look at that, you can see it's about the same, right? Where SPY's returned 326% and XLV with all those dividends put back in there has returned 477%. Now, all the information that you do see here today is from Seeking Alpha, and I am a Seeking Alpha affiliate. I'm supposed to mention that. There is a discount link down in the description if you find this information helpful and you think you would get benefit from joining Seeking Alpha. That's all I'll say. Let's keep moving. So now let's look at a 10-year chart. This is the price return for XLV versus the S&P 500. So XLV there is in orange, S&P 500 is in blue. And over this 10-year period with that nice long bull run, right? Then we had what happened in 2020 that we don't talk about. Then we had a nice recovery. Then we had last year, which was a little bit bonkers. So including all of that, we get a nice XLV return of 205%. Pretty darn outstanding. The S&P 500, also pretty darn respectable, right? At about 170%. But I know which one I would pick. I'd take the 205% because I'm a genius. Now, let's shorten the period down more. Let's go to a 5-year period. And same exact thing. XLV in orange, the S&P 500 in blue. So now we're getting into more craziness that has occurred over the last 5 years. We're shrinking this period of time down. But still, in the end, XLV comes out ahead slightly, just about 60% versus the S&P 500 at 56.5%. So not too big of a difference, but still beating it out over the last 5 years amongst all this mayhem. Now, how about a 3-year price return chart? Again, orange versus blue, and we can see this includes 2020, the very beginning of that, going all the way through the recovery process, and then last year. And again, we see it just beating it out slightly. XLV at about 27%, the S&P 500 at 22%. Finally, one more, the 1-year chart. Last year, I know, it was a rough year. S&P 500 was down about 9.43% over the last year. We're in February now, but pretty close to last year, right? So down 9.43%, and XLV down just 2%, hanging on just a little bit better. That's pretty considerable over a 1-year period. Well, I guess I lied. I do have one more chart to show you, and I find this one pretty fascinating because this is a 1-month chart. So we've been on this nice run over the last month or so, starting at the beginning of 2023. And while I was kind of bearish, still am, a lot of people think this is the beginning of the next bull market. So we'll see where we end. But XLV took the month off, right? It's down 1.5%. It did not participate, whereas the S&P 500 with several sectors that were very successful and technology stocks taken off is up nearly 5%. So that's like a 6.5% swing over the last month. So is it buy time for XLV or is it the end of the road? Well, I suppose I'll let you make that decision for yourself, but certainly you're better off buying it right now at 131.62 compared to early December where it peaked out there right around 140. Now, when I look at this fund, as far as the expense ratio, we see it's just 0.1%. So quite affordable as far as the expenses go. That means for every $10,000 you invest, they're going to take $10 away from you to manage this fund. Not too bad at all. It does pay a dividend. It's right around 1.5%, and that's paid out every quarter. It's got about $40 billion in assets under management. And overall, it's a very solid fund. So altogether, this fund has 65 different individual holdings, and it starts with United Health Group at nearly 9%. Then it goes Johnson & Johnson, which I own directly, Eli Lilly, Merck, AbbVie, which I own directly, Pfizer, which I own, and Thermo Fisher, Abbott Labs, Danaher, and Bristol Myers, which I own directly. So I buy some of these individual stocks. I regret not buying United Health Group a long time ago because it's been an outstanding performer. We'll look at that here in a minute. But a nice breakdown there, and those top 10 make up about half the fund, 53%. But if we look at United Health Group, again, just to look at individual stocks, I know people don't like to buy necessarily individual stocks that like to buy ETFs. And I think that's a wise decision for us, retail investors, for many of us. Keeps it a lot simpler. By just looking at United Health Group to understand where that one came from, look at the price return of that over the last 10 years. Look at this. Versus the S&P 500. Remember, it turned 170%. United Health Group, 750%. Wow, amazing performance by United Health Group. And again, that makes up 9% of this particular fund. Now, there are plenty of peers to XLV if you want to explore other options. I do like to focus on the expense ratio, so always take a good look at that. You can see, again, XLV is at 0.1%, whereas RYH in this chart is at 0.4%. But I've looked down at the bottom, you can see I've also included the price return there over a 5-year period because Seeking Alpha does a great job of presenting this information. You can see that one's returned 64%. So it's outperformed XLV. So again, don't just jump into XLV. It's healthcare that's really been so successful. So just a good sector to explore, and you can kind of see which one fits, or maybe buy 2 of them and kind of balance yourself out even more. Take a good look at those holdings. Pay attention to that expense ratio. Now, I do own some shares of XLV. I bought them a couple years ago. I wish I would have bought them way back there in like 2020. But instead, I was buying things like Enron and America Online, making great decisions, great financial decisions as a younger person. But, you live and you learn. But anyway, I do like this one. I love the makeup of the fund. I love all the individual stocks that are in there, a lot of them. I own some of those individually as well. So I'm going to continue to add to this position as we roll forward. Now, if you have any questions on any of this at all, just ask down below. I really appreciate you watching. Please like and subscribe, and we'll see you next time. Take care. Whoop.